Right now, the economy seems to be falling apart. Things feel uneasy, and we keep being told things are good, but they don't necessarily feel good.
They're
right
not
now.
good. That's why I'm sorry for being late, guys. We were debating.
Well, Ken was disagreeing with some numbers I
love
pulled.
it, but
So
I said let's do this live.
You tone it down a little live, but
no, okay, I won't.
No. But it's interesting right now, because what we do know is unemployment is going up. How much it's going up and what it's at, that's debatable depending on
I got to
what
tell you guys
stats.
something really funny. So, I discovered the SAHM rule, SAHM, who is an economist for the Fed. But before we go on the chart, Jerry, I text George Gammon. And I'm like, hey, George, do you follow the SAHM rule? He texts me back, do you track rents? Like, it's so obvious to him, right? But I started following this. I think it's important, Jerry, if you could pull that up real quick. Now, this is not necessarily, it's just an indicator, I think is what I'm trying to say here. But basically, the SAHM rule is around the unemployment rate, which we're going to talk a lot about. And it's the 3-month moving average of the U.S. employment is 0.5 percentage point or more above the lowest 3-month average percentage period for the last 12 months. So that's what it is. Now, I just want you guys to take a look at that far right. Now, what I really want you to look at is when it started going up. Let's go back to 1970, call it 73, 80s, the 90s, in the late 2000s, of course, in 2008. Obviously, the big spike is the pandemic, which we all know. And so I don't know if you want to call that an anomaly or whatever, but it's probably not indicative. It was a kind of a man-made thing. It wasn't really economic. But this is an indicator. And what this means is that there's more people out of work, right? Mm-hmm. And, of course, the BLS can only hide for so long, right? Right. Where they post something and then they readjust it later. But this SAHM rule, again, just an indicator, but something that you guys need to watch, is pretty interesting because when you have people out of work, then you have savings down, you have their spending less, you have debt going up, which is already bad, credit card debt. You got, food stamps up, you got welfare up, you got people's morale and just their spirit, their mental health. All that stuff gets rattled. Let's don't forget, we've had a low period of time. Look at that, guys. Look at let's call it, what do you want to say, 2009, maybe 2010. You guys have not really experienced. We've had 14 years of pretty stable unemployment, except for the pandemic.
Well, yeah. Let's take a look at some of those numbers from 2019 on, Jerry. Yeah. If you want to pull those.
Yeah, let's go back.
The chart that you made.
Yep. If you go back, there you go. Yeah.
So basically, we didn't put it in here, but unemployment kind of peaked at 2010, it went up to, I think, 9%.
Yep.
But since then, it's been slowly coming down. And in 2019, it hit 3.6%.
Yeah, and it was where it is today, it was November of 2017. So that's important to know that we haven't had an unemployment rate since about, late 2017. That's where we are.
Yeah, and I think you have to really disregard 2020. I mean, everyone was unemployed. The government paid everybody, whatever. So when you're looking, basically you're seeing this steady sweep from 2022 to 2024 where the unemployment rate is going up. And since 2010, the unemployment rate every year has went down. So basically you kind of started high at 2010 when we had the great, recession, they call it. And then it kept going down every year. It got a little better. Now it's starting to tick up. So while we're in the same spot we were in 2017, it's really not the same spot because 2017, every year it had started to come down. Now in 2024, we're starting to tick up.
And this is what's important, guys. When you look at these numbers, they might not seem like a lot. But when you go from 3.5, which is just a couple of years ago, to 4.4, almost a full point, we're talking about millions of people. So when you look at it, it doesn't seem significant. When you go from 3.5 to 3.6 to 3.7, let's say, it doesn't seem significant. But it is. These are real people losing real jobs or can't find jobs. You've got, as you guys know, savings went down. and credit card debt went up. And so, we're talking about millions and millions of people, and this is something to watch.
And I think some, other data points that are interesting is, 2007 is obviously right before everything started to collapse, and the unemployment rate then was about 5%. But then at 2009, it maxed out to almost 10%. So it went up 5% in like the worst period of time in the worst recession we've like ever had in our recent lifetime. So the fact that it just went up 2% in a couple of years is significant.
Right. And that's we've all been blessed with low unemployment. And to be honest, that's one of the Fed's mandates is unemployment. But they've also said that it's been too low. I mean, they've come out publicly, just look. And so what's happening is we're driving more people to the unemployed. And what that's going to do, it's going to put pressure on any of the businesses. And this is kind of the point of the video. The reason we're talking about all this is because when there's less people spending and less people getting into debt, and interest rates are still high, and maybe they go down this week. That's yet to be seen. But the consumption is such a big piece of propping up the economy, and that is going to go the opposite way as unemployment grows.
Yeah, and I think we need to look at all areas, right? So these were just the unemployment numbers. So if we want to turn and look at jobs, Jerry, can you pull the Challenger Gray and Christmas
This is interesting.
title?
Yeah.
One second. But anyways, Challenger Gray and Christmas reported that layoffs surged in August and hiring has hit its slowest year-to-date pace going back to at least 2005.
Is this a chart we're looking at here?
No, that's just a headline. I don't know if Jerry has it.
So repeat that again.
So layoffs surged in August and hiring hit the slowest year-to-date pace going back to at least 2005.
Okay. So, but let's go back to that jobs chart, Jerry, if we can, because I think that's important. And also, as you guys know, obviously, you got to kind of throw out, the 2022, time frame, because and it's really cool that most of those people kind of came back, and the economy, I guess, stabilized from an unemployment standpoint. But from that point, what we're starting to see is job creation go down. Look at that.
Yeah, but here's the thing is these job reports, people are all over these. They're not including people that got 2 part-time jobs for their full-time job. So really, that's why you're seeing the up and the down, and the up and the down is like, it's just not accurate.
Also, if you really look at this is going to upset some people, and maybe not others, but the majority of the job increases on a percentage basis. The number one employer, the government.
Right.
Like that's more government. That's a fact. Just go look, guys. So, you can't mess with the facts.
So, Jerry, if you want to pull up the, or I don't think I actually gave this to you, but the Atlanta Fed report came out, and then wages are up 15% overall from the beginning of the pandemic till now, and wages are actually starting to soften, but they're up 15%. Overall inflation, according to them, is up 18% from 2021 to 2024. So you have a 3% gap in people just statistically based on, their numbers are 3% less spending power than they had before the pandemic.
And it's going to get worse because what happens is when there's more people on the market, like right now, we're looking for various positions. At any time, our company's looking for 10 to 20 positions at all times. We have a full-time in-house employee recruiter, essentially, because when you get to a certain size, you just have natural turnover. People are moving, people are leaving, whatever the reason is. We got new people coming in and at all times. And so what we're starting to see is, and this, by the way, this is not just me, is you're starting to see hundreds of resumes pouring in for positions. This was not the case 2 years ago. And so obviously this is a very small sampling, of course, but this is what's going on with our company. We're starting to see. And so what that does, obviously like anything, guys, when there's, let's say, 20 people trying to become a bookkeeper, let's say, as an employer, you have more options when it comes to salary because you have 20 choices versus if there's 2 or 5. So, because now you're kind of beholden a little bit to the employee as you're negotiating, and they're negotiating because it's, let's say, a job market focused more on the employee. But when it's more, now it's going to flip. So the employer is going to have more to be able to negotiate because there's more options. Just like anything, it's a supply and demand thing. And so that's another thing that's going to happen with unemployment. And don't forget about the people that are working. When this is important, and this isn't discussed very much, but when an unemployment rate goes up, and you now people that work for us, let's say, they know people that are looking for a job, and all of a sudden they're wondering and they're concerned about their job. So so even there's a mental health piece and a morale piece that the employers are going to have to tackle, because as unemployment goes up, they're going to be wondering, I wonder how our company's doing. I wonder how financially, we're because everybody's unfortunately getting crushed by inflation, and savings are down, and credit card debt's up, and it's a horrible spot.
Well, and spending, this is going to affect spending, right? Obviously, people losing their jobs affects spending. But to your point, so does other people losing their jobs. Because it's like, well, should we do that vacation to Florida? I don't know. Maybe we shouldn't do it this year because we don't know if we're going to lose our jobs. I know people in that situation right now where there's talks of them losing their job or their company's doing some layoffs, and they're, pulling back on all their spending.
Correct. Right. And that's kind of the point. Like, the signs are all around us, right? Like, I know people, I know companies that are laying off, and when you have an employee that's still there, you're like, oh, am I next? Right? That's a real thing. So, so what they're doing is they're hedging, and they're saying, I'm going to just pull back and build my savings and build my reserves.
So interesting. Michael Shane said unrelated, but I think it's very related. He said Andy Jassy from Amazon just issued a 5-day-a-week return to office memo today to Amazon workers. And that is interesting because, we do talk about this, but the employees have had a lot of the power the last few years to dictate their salary. They've been jumping from company to company. They've been having remote work and flexibility. And now that there's more people, that's what these owners are seeing. They're seeing people applying, and they have tons of candidates willing to come in 5 days a week. They're like, well, why don't we just do that?
Yeah. And you guys, some of you are business owners and some of you are not, but you just need to understand the situation. It's the hand that's being dealt today. Like I said, when I have hundreds of resumes coming in, it's going to be easier to negotiate.
Well, and to Michael's point he just said here, return to office is an easy way to cut staff.
Correct.
They won't return to office? Perfect. All right, they're on the list.
Politically, they don't have to deal with that, right?
Yeah.
They don't have to deal with layoffs. They can just say, we're returning to office. The thing is that the people that are, people need to understand that if they want to make a good move, they should just say, okay.
Yeah.
And then decide. Like if you're just like, screw you, like the economy is not the same as it was even a year ago or 2 years ago. It's just not. There's more people looking for your job today. There's more people trying to figure stuff out. And, these higher rates, this higher inflation, these higher living costs, we looked at a couple other folks that are actually tracking real things. I think we did it like a week or two ago. And we just started looking at, individual things that we all consume and use. And I think inflation's significantly higher than what's being reported.
It is. And, Powell said something interesting. He said, we're on the path, inflation is on the path to 2%. So that's his quote. So, yeah. So it's on the path. But what he's not saying is
transitory high. It's transitorily
when they start cutting rates, it's going to go up. So it's easier to say like, okay, we didn't hit our 2% target, but now we need to focus on the workforce because unemployment is starting to get higher and we don't want a recession. But instead of saying that, said, okay, it's on the way to 2%. So now we're going to focus on inflation, not mentioning that cutting rates is probably going to make inflation go back up. But that's kind of their new little tagline, on the way to 2.
I know. You guys, you just got to dig a little deeper here. Like, one of the things that you all know now is when rates go down, people start buying and consuming again. That is going to happen. Everything is going to, all boats lift, right? So you're going to see people start buying consumer products. You're going to see finance them, I should say. They're going to get into debt. They're going to buy cars. The used car dealers are going to be all over, and the new car dealers. By the way, they're in trouble. I don't know if you guys have really dug into that, but I watched a video last week about the guy was picking on the Ford dealerships. The Ford F-150 trucks, which you couldn't get, are you got a massive inventory because they produce them so fast. So and it's all has to do with debt. So as debt goes down, things like that go up. Also, what will also help refinances. Hopefully, let's cross our fingers because that's what we want. But that stuff also drives pricing up again. That's kind of the point.
But I also think it's important to note that prices are softening on things people don't need, right? So prices are softening on, some kind of like Airbnbs. Prices are softening on, I think toys was the category that they just came back in, that things were softening. Used cars are softening. But things that people need like food, like energy, like
how does toys
housing,
get a category, by the way? Like toys is a category?
Anything that helps. But housing, anything like that, it's not really softening. It's flatlining or going up. And so it's nice to say, sure, the increase in inflation was X amount, but really the things that people need were going up while the things that people don't necessarily need were softening. Even a used car. People don't necessarily need a used car. Not like they need food. People have to eat every week. A used car, you can kind of stay in your old one or you can take public transportation. But these things that people absolutely need, food and housing, continue to go up.
Yeah. And let's talk about what people can do, because I think that's important.
Well, okay.
But I just want to, I think the point of this video and the point of this live is the unemployment rate is real. These are real people not being able to work that are actually going to go into the system, and that there's going to be money spent there. Okay, so what does all that mean? And what are, if you're in the system or you're trying to find a job or you have a job and you're asked to go back to work, what are some of the things? And I'd like to hear from some of the folks that are weighing in here, because there are moves that you can make to minimize the sting. And I think it's important to address.
Well, I think for one, you need to be a good employee, and you need to get rid of the laissez-faire. I'll get a
laissez-faire.
I'll get a new job if you don't like it. You don't want me in the office, I'll just go get a new job.
Right.
Whatever, fire me. Like that kind of attitude's probably not good right now.
Right. I think, guys, the employer is going to have an upper hand here, at least for the next couple of years. It sure looks like it. So that's number one. So it's almost like rent, like right now rent's soft and you're not going to see big rent growth. As an employer, what you want to do is you want to renew those leases. But as a tenant, what you should be doing is looking around. Right now, it's the opposite for jobs, right? You're starting to see more people looking for jobs, and so so you have to kind of look at what's happening. And one thing is for sure is there's going to be a much better rate on rental housing for sure. We're seeing softening. We're starting to see concessions. There's like 500,000 units hitting the market right now. 500,000, 500,000, adding supply. Now, it might not be in your area, but I can assure you those are real things being built by real people. And so this is a temporary little window. So you've got make sure you shore up that now and you look for the best deal you can.
Yeah, and I think we need to touch on debt, right? Because that's the other piece of this puzzle, is the debt market.
Savings goes down and debt goes up when unemployment goes up.
That and before we hop into that, first, Jerry, can you pull up the Real Estate Strategies podcast? Oh, the new name, the Ken McElroy Show podcast. Make sure you guys check this out. This is going to be a little more high level. We're going to deep dive into what MC Companies is doing, what Ken's reading, what he's looking at. And it's on every Thursday. It's on any of your podcast apps. So just go ahead and scan that. And
by the way, I would love to hear from you guys. Like, what do you want to hear? Because what we've decided is we're going to get way more in depth about some of the moves we're making as the Fed rises or lowers rates, as inflation goes up and down. A lot more detail. We're going to do it a little bit more long form, and we're going to talk about what we're doing in the company, what we're doing both personally. So anyway, we'd really love to hear you guys.
Yep. All right, so let's hop into debt. So debt is interesting because the Fed is going to be focusing on these interest rates starting probably here in a week or so, right? A few days.
I love it, man. Like, obviously, you guys all know we're in the real estate business. Like, we just got the hell beat out of us the last 2 years as these rates have gone up. And, a lot of my friends are in big trouble,
right.
And we even have some properties that, we've had to shore up on a construction and stuff that we bought where the rates have gone up. Thankfully, we have the dry powder to do so, but there's plenty of people. We just saw this at Limitless that are in massive trouble. So lower rates help. They help.
They help everybody.
I don't know how much.
They help people that are in debt. They help people with credit card debt. They help people on used car loans. They help people on school debt that's not set. They help people with mortgages to refinance. They help real estate syndicators to get lower rates on their apartments.
Title companies, mortgage companies,
everything.
realtors, everything. This will help everything.
It'll help everything except inflation.
Yes.
That's what it's not going to help. So it's not going to help inflation. It's probably going to set inflation back on fire as they lower rates.
So we could be in a bit of a yo-yo going back and forth.
Right.
So it'll be interesting. And don't forget there's a lag period too. So, historically, when rates have gone up and inflation has gone up, there's a lag. They've even said it could take up to a year before you really see the effects of an interest rate increase or decrease. So just Google that and you'll see. So it's not immediate like a lot of people think. It takes the time to kind of make its way through the economy. So in a positive note, one of the things this election is going to do, it's going to put they're going to want that economy in its most stable position, right? Just think of that. Of course they are. Like, it doesn't matter what administration you like. It's just the fact is the economy. They want the economy to be in order. Come November, and so they're going to do anything and everything they can. So be careful in October and November, guys. Specifically, probably October. Really dig a little bit deeper on the numbers. Really, really do your research because I think you're going to see a lot of hedging. And, even with these unemployment rates, like, the BLS would come out with these numbers and then they would do massive adjustments later. There was an 1,818,000 person, like this is 818,000 people adjustment. Just go Google it and look, over the last, year period, I think it was. So it's crazy. Like, guys, like, so when when they come out with an unemployment rate, you should always think, is this real and accurate? You'll read something, and then you might read something else later. So this is a time for you to really dig in and start to take a look at some of the other things.
So I think that it's important here because the Fed is probably going to start focusing on unemployment instead of inflation. And this is why, we've always pumped, you need to be in assets that move with inflation, like heavy metal, like gold, like real estate, those kind of things. I mean, even the stock market even though it's not a hard asset, it tends to move with inflation. So, the worst thing you could be doing right now is saving money in your bank account.
So guys, this will make sense when I say it. When there's more people looking for work, there's more people on the system. That costs money, right? There's more people getting unemployment. That's the whole point of it, right? It's supposed to be temporary. It's supposed to be, a hand, to move you from A to B. That's the point of it. But there's going to be more costs. There's going to be more food stamps. There's going to be more all this stuff in the middle of this homelessness issue, which is spending a lot of money there. In the middle of this immigration vouchers and all the money being spent there. In the middle of already high inflation, and in the middle of high credit card debt. In the middle of student loan debt. So all of this is happening now, and this is why Danille and I were talking this weekend and says, is the economy about to fall apart? There's a lot of stuff actually going the wrong direction right now.
Yeah, and the government's really trying to skew all this until the election, obviously. They're trying to, not count unemployment numbers correctly. They're trying to count 2 part-time jobs as 2 jobs, even though somebody lost their 1 job and had to get 2 part-time jobs. And they're doing all these job revisions, on the back end because nobody pays attention to that. But the biggest thing is just look around, right? Like, who do you know that's lost their job? Is your company laying off? Do you know if companies laying off? Go and jump on Indeed or whatever. Look at what jobs are available, how much they're paying. Look at all this stuff because it is really impacting. The economy is really getting impacted here. And the politicians don't want us to know about it, but we're not stupid, and we can, you can kind of get that gut feeling and you can see different things. I have a friend, she always takes a part-time waitressing job on top of her other jobs. She can't even find a waitressing job right now. Like, the restaurants aren't hiring, people aren't hiring. I mean, it's not like it was a few years ago.
Everything's down, guys. Mm-hmm. And so the interesting thing is whoever the next president is going to have their hands full,
Well, you even had an Uber driver the other day that was a contractor, right?
Oh, my God. He was a microbiologist, right? I went into town and had a business dinner with a bunch of folks, and I had a couple cocktails, Ubered home, and this guy was all buttoned up. I mean, a sport coat on and a nice white, and I'm like, what do you do? And he's like, oh, I'm a microbiologist, and we lost our contract, and I'm like, oh my gosh. And he's like, I moved my family here and I don't want to move. And anyway, it's a small example, but an example. And I just think, I'm like, well, good on you, man. He's like, yeah, I'm gonna figure this out. Would have never guessed, but that's what happened. And so I think you're gonna start to see. We're already seeing it, guys. Like, when you think of the unemployed, I don't think you think of somebody like that. I don't think you think of, somebody that's super degreed and was making a lot of money, and then isn't, right? So and you know what actually is going to be the safest? The tradesman, like it's actually awesome. Like, well, the plumbers, the electricians, all those folks, man, like people that are really doing stuff, like the people that you need, like they have to come over and they actually do real stuff. The white collar, they're the ones that are in jeopardy, in my opinion, because with AI and everything that's happening, you can do less with, you can do more with less people. And but if you need a dishwasher, you still need a dishwasher, right? Like, that's my point.
Absolutely. So let's jump into our premium questions. If you guys want to join premium, you just go to kenmcelroy.com/join-now. You can ask us questions and we answer them on email or on here. So Chad is asking, and also on YouTube, please ask any questions you have. I'll get to a couple. Chad's asking, how important is it to diversify markets? I currently have 95% of my single-family home portfolio in one single market.
That's a good question. So here's the way I look at things. I actually go back to management. So and hear me out. If you're in a town and you have all your properties in a town, my guess is you're in 6 or 8 or 10 different submarkets, right? Unless you're all in one little submarket. So let me give you an example. We've had I had a property that was near a military base, and when the military base deployed, the town was decimated. All these people left. Okay, that is risk. Now you could be in a town like Phoenix where there's hundreds of employers all around, and you're probably not going to be at risk. So a lot of it has to do with that. But the other thing is management itself. So if you have a vacancy in an area, and you can't fill it, that's probably the biggest issue. So if you're in a really, really strong sub-market that has really strong demographics long term, and of course I know that each side of the street can be different, that's fine. But you don't have to be in Cleveland and Portland and Seattle and Boise and Phoenix, and you don't have to do that, because you probably have that kind of diversity inside of Cleveland, inside of Columbus, inside of Phoenix. Phoenix has hundreds of submarkets, and some of them are, you can drive across the street and be $1 million homes, and right across the street can be $200,000 homes. So, and with different school systems and stuff like that. So when you say that, you don't necessarily have to be all over the country for diversification, but I am a big fan of diversification, because I do believe there's different economics. We were talking about this weekend. Danille's like, oh, I want to go buy this house. She's showing a friend of ours a home in an area. She's like, I love this area. And I said, well, let's do the math. What is the cost of the home and then the rent? Well, if you look, you can buy something, remember, where the rent is significantly more for about the same price of a home just a couple miles away. By the way, one's Phoenix, one's Scottsdale. So you have to look at it from that standpoint. You have to look at the very basics, and then you can decide, is it better to diversify? But I still think that diversification, the answer is yes.
You like diversification, but you also like neighborhoods that work, because I have a condo I'm thinking about selling and rolling it somewhere else because my HOA fees have gotten out of hand. And you were like, I was like, well, maybe I'll look at this house in Phoenix. And you're like, but the one neighborhood you invest in, Scottsdale, does really well. Why don't you just invest there again? And I said the same thing. I'm like, well, then I have 3 of my properties in one neighborhood. But you're like, yeah, but that's like, you can't go wrong with that neighborhood. So if you're in a situation where your stuff's cash flowing and you feel like you've hit this niche and it's a long-standing market that's not reliant on one industry, then might just be good to stay where you're at.
But let's look at some risks. So let's say you own 8 or 10 properties right near a university. Okay, that's risky in my opinion, because now you're reliant on, let's say, the enrollment of the university, the health of the university, all those kinds of things. And of course, people that experience COVID, like my kids, they all got sent home, and they're like, well, now I can do school and finish school from where they grew up. So, that's risk. Or, the what I was talking about with the military base deploying. So those are risks. But when you're in a market that is super diverse from an employment standpoint, like there's lots of choices, and people can move out of one industry and move to another, then I think you're a little bit better. Like Scottsdale is one of those markets where there's thousands of employers here, and there's some that are doing great and some that aren't doing great at all times. And but you're not reliant on, let's say a small basket of employers kind of propping up an economy, like oil and gas would be, if the oil and gas business industry goes down and, oil prices go down, it's not going to affect Phoenix, but it will affect Tulsa, Oklahoma. It will affect Houston, Texas. It will affect, some places like that. So you have to look at the bigger picture.
Absolutely. So Julia had a good question on YouTube. She says, hi, Ken. Should we have cash on hand so we can buy when a recession hits?
100%. Yeah. By the way, we're heading into a dry powder period of time. Like you're going to want.
Do you think, though, because I know multifamily is, do you think single family is too, where you're going to want dry powder?
Well, let's put it this way. Do I think prices are going to go down? I do not in most markets. But do I think interest rates are going to go down in the short term? I do. So what maybe didn't cash flow today or 6 months ago might cash flow in the future. So having cash to be able to, you were just talking about this. Mm-hmm. Danille's like, I want to buy another rental, but the numbers aren't working. Well, 1 point, 1.5 points, we're already seeing rates in the 5s. Guys, this is good news. Even if your cost of housing is a lot, because in the areas we're looking at, the prices they've gotten soft, they've kind of flatlined. But if rates go down, it makes things a little bit better. And so, yes, I always think you should have dry powder also for emergency purposes.
Right.
Always have dry powder at all times, and that's actually, remember that young man we were playing golf with this weekend?
Mm-hmm.
He's like, I got 1 year of dry powder. Like he knew, like exactly. He was 22, 23 years old.
Yeah.
I love this kid. Anyway, playing golf with my son yesterday. And he's got all kinds of cool stuff going. He's buying rentals and stuff like that. But the point is, he knew exactly how much money he had. He had 1 year's reserves. And I think it's important that you understand that at that level.
Yeah, absolutely. And then Finn is asking, can you share any of your metrics that you use at MC? Target ROA, ROE, equity percent, etc.
Yeah. So I tell you what, those are those acronyms. Maybe not everybody doesn't understand them, but I will tell you this. We have a tried and true one. For me, it's always the same. Same with my partner. My partner, the wise sage Ross. We go back to the very basics. Like, what is your cash on cash? Like, period. That's our biggest one, believe it or not. If I'm going to take money out of a 4.5% 1 month T-bill and move it into real estate, what is my cash on cash? Because I know I can make 4.5%. The government's going to pay me that. Okay. So I go back to the very basics. So for me, I always buy for cash flow, not on capital gain. Now, how do I get there? And that becomes a series of metrics and KPIs and things like that. From are people moving there? What's the school system like? What's the affordability? What are the single family home prices in that area? I want a big jump from rent to mortgage, for example. Like the property we just bought in Vegas. The average rents are in the $1,500-1,600 range. Well, the homes in the area are $1 to $6 million in that particular area. So now it's a really nice, affluent area, beautiful project, and it's highly occupied, because people want to be in the area. It's next to Whole Foods. So those are all metrics, and Danille and I, when we did this van trip that she loved, we used to look for Airbnbs around Whole Foods, or look for like these really boutique high-end things, guys. Look for those, because those have some really smart people deciding, where do we want to put a Whole Foods? Where do we want to put a Lululemon? Where do we want to put high-end shopping areas, as an example? It's not always accurate, but you should look for those, and then you want to buy in around those areas. You want to buy affordably in those areas, and that's what we look for. Those are some of the metrics we look for, because I was years ago, I was playing golf with a guy that he had the greatest job. This is back in the 70s and 80s. His job was to go find the right corners for McDonald's. Mm-hmm. And I'm like, oh my gosh, what a great job. Like, he lived in Chicago, which is where McDonald's is from. He used to fly all over the country. And he would literally, because they had all these people that were trying to own McDonald's, and he would look at the corners, and he had all these metrics. So you start to see these really smart folks are out there doing this already, whether it's Whole Foods or whatever it is. Follow that. You don't always have to be the smartest, Just look at the signs.
Yeah, absolutely. All right, guys. Thanks for checking it out. We'll see you next week.
Cheers, guys.